The patterns, reversal patterns, for instance, like the false bull flag and the false bear flag, they're one of my favorites because when I first started, I bought this book called Technical Analysis of the Financial Markets by John Murphy. I'm telling you all right now, if you want to learn how to trade in a 90% club, you have to buy John Murphy's book, Technical Analysis of the Financial Markets. That book is the retail trader's Bible. And everything in that, if you fade it, in the instances where I tell you how the market's going to trade, you have a 90% likelihood of winning and that stuff failing. So I'm going to teach you a secret on how to capitalize on fake or false bull flags. And the same thing would be said for a bear flag. You're just going to reverse everything I'm going to say here in terms of the logic, okay? I want you to look at how the market created this situation now here as we were outlining. So at the bottom of the daily fair value gap that we outlined yesterday beforehand, look at how the pound, you see how at that moment when we were trading down here at that candle, that's this candle there, the market rallies up. And what's it creating here? If we were just looking at the chart like that, a 20-year-old inner circle trader, I would have been buying that right there. Without the information I've provided to you, that right there, I would have been buying that. But that pseudo or fake bull flag in the pound is occurring at a time when the dollar index is at its deepest discount. When you see a pattern like this, when the dollar is doing something like that, what's going to have more emphasis or strength? The dollar is going to break the knees of any bullish retail pattern that you see in a forex pair. So what that means is you can fade this bull flag and then you get the false bull flag that breaks down. But now this is what I want to teach you as well. So what you do is you looking for any inefficiencies. This fair value gap here, that will be a bearish fair value gap. You can see them working that level. But more importantly, the flagpole that would be used for a bull flag in retail thinking, that's my inversion fair value gap. You have a retail bull flag that will fail. When it drops down here, the only thing it's doing is creating the inversion fair value gap that eventually trades up to it here and then aggressively moves lower. What is it going to attack? It's going to attack sell side. Where's sell side? Relative equal lows. When you have relative equal lows, you use the lowest of the low. That's where the liquidity is. If, this is for your notes now, if the lower low has a long wick or tail, use the consequent encroachment and it may not sweep below it. But when it's blunt-ended candles like this and it's the lowest one, it's just simply use the low. And that would be this. And there's your sell side run. Reversal patterns, for your notes, you want to be using a correlated market. In this case, if you're trading forex, you're going to be looking at an inverted correlation between the dollar and the forex pair that you're trading. So if you're going to have bullishness in the dollar index, your mindset should be switching to, okay, what do I have in the marketplace for pound that would instigate or promote a short entry? Where would the market trade to if it's going to go lower? Well, let's go back to that beginning of that bull flag right here. Retail sees that as it's going to go higher. Pseudo ICT guys see this as it's going to go higher because it filled in this and it's an order block right there. Wrong. That is not a bullish order block. Why is this down close candle not an order block? It's a mitigation block. Allow me to explain. We have this low up to the high of the bull flag. So that's your dealing range. Why is that a dealing range? Sell side, taken, rallies. Above here, buy side. So we've done both directions. Equilibrium's right here. If the market's rallied, is that a bullish order block if we're above equilibrium? Absolutely not. Now, can price come down to it there and have a little reaction? Absolutely. That's the bait. What you're going to want to see is that down close candle trade through it. Weaker-minded individuals that would use that as a catalyst or springboard for higher prices, they're in a net loss when it trades below it right there. So now in their mind, they're thinking, I would really like an opportunity to get out of this losing trade and mitigate that loss. Oh, well, now if you take that, so here's that down close candle, look at the high, and look how that performance is right there. It overshoots that fair value gap. Where's it go? If it's going to color outside the lines of that, where's it going to go? The mitigation block right there. So when the market does these types of things, you have several factors here. Remember I was telling you, a PD array in and of itself, one thing is useless. You have to have three things to confirm it. So what do you have here? Mitigation block, inversion fair value gap, the dollar index creating a reversal scenario. So if the dollar's going to go higher, that's going to put a lot of resistance on any advance or moving higher on foreign currency. And then you have situations like this, where the market just really just falls out of bed.